Howdy, Jacob here. Today we're looking at Wolverine World Wide, ticker symbol WWW. It's in the textiles, apparel, and luxury goods industry. It has a $680 million market cap on $1.2 billion enterprise value. Looks like they design, manufacture, source, market, license, and distribute footwear, apparel, and accessories pretty much globally. Their revenue has been relatively flat over the last 10 years, 10.691 billion in 2013 to 26.85 billion in 2022. It looks like it went down before going back up post COVID. Margins are relatively the same on the gross margin side, about 39.6% in 2013 up to 39.9% in 2022. But on the operating profit side, we're seeing operating margin quite a bit lower, 8.7% in 2013 down to 4.9% in 2022. But they have consistently paid a dividend for the last 10 years. Return on invested capital appears to be about mid-single digits. Their dividend yield, I do not have up actually. Let me pull that up. Their current dividend yield is 4.67%. Let's look at that debt first. That enterprise value is almost double market cap. $723 million in long-term debt, $435 million in short-term debt, with only $132 million cash on hand, cash and cash equivalents. And so we're looking at over $1.1 billion in total debt with just $132 million cash on hand. So $1 billion net debt, and their 5-year average free cash flow. 5-year free cash flow is really all over the place. It looks like it goes as low as negative 200 million to as high as 290 million, averaging about $80 million on a 5-year average basis. Their dividend payout in aggregate is about 33 million, and their other uses of cash appear to be stock repurchases and then acquisitions, with debt going up and down between issuance and repayment. So we're seeing about probably 40% of their free cash flow paid towards dividends, maybe 40% to stock repurchases, and then 20% in acquisition on roughly a 5-year average basis. That's pretty close to what we're seeing. And so I think we're ready to get to some assumptions here. With their dividend, with their total payment being about $80 million on a 5-year average basis, that's quite a bit of debt. And so we're seeing $1 billion net debt here when, they've had years where they produce $299 million in free cash flow, which compared to that is not very large. That's just a little over 3 times. But on a 5-year average basis, which is really what you got to be looking at for businesses that are not extremely consistent, we're looking at over 10 times their 5-year average free cash flow with the amount of debt they have. So that can be concerning. And with 400 million in short-term debt, that also might be a concern. And so let's start making some assumptions, though. I think it's relatively flat business. I'll say 0% over the next 7 years, 10 on the 7 years from now P and price to free cash flow. Their margins, I'll take roughly an average here. 3.6, let's do 3.5. It is nice to see that their free cash flow was looking a lot, almost consistently higher than their earnings, so that's good to see. But still, recently has been rolling 12 looks good, but 2022 was a rough month. So then the share change looks like they do buy a bit of shares here. I'll say that they buy back 1% a year for the next 7 years. The dividend, I mean, we're saying the revenue is going to be pretty flat, and so to me, I think they're going to want to use some of that cash to pay down debt, hopefully, to repurchase some shares, maybe make some acquisitions. But to me, I think I'm good keeping their dividend flat, which currently at 4.6% dividend yield, not too bad. But again, their balance sheet was iffy with light liquidity, a good amount of debt, and then the free cash flow on an average basis to debt was a bit high. So just make sure if you do want to invest in this, you're comfortable with the debt situation. To me, based on my assumptions here, it needs to fall 30%. The stock price needs to fall 30% before you get a 15% return. To me, I'm waiting until it gets closer to do more research on the debt. Please be comfortable with the debt before you ever think about investing in any sort of company, because that can be the biggest hindrance that is not included in the present value of earnings and free cash flow assumptions here. But hopefully everyone enjoys the video and has a great rest of the day. Thank you.